Welcome to the exciting world of banking history. It's time to take a journey back in time and explore how banking has evolved throughout the ages. Let's start with ancient banking, which dates back to 2000 BCE to 100 CE. Yes, you heard that right. Banking has been around almost as long as humanity itself. The first recorded evidence of banking activity was found in ancient Mesopotamia, where merchants provided grain loans to farmers and traders. Temples and palaces in Babylon, Egypt, and Greece served as repositories for valuables and issued loans to citizens. Moving on to Rome between 100 BC to 500 CE, Roman banks, known as mensae, were involved in currency exchange, deposit taking, and lending. Money changers and money lenders played a significant role in the financial system. They provided various financial services, such as money changing, lending, and deposit taking, and often set up their businesses in the Forum, the center of commercial and political life in ancient Roman cities. Now, let's jump to medieval banking from 500 CE to about 1400 CE. After the fall of the Roman Empire, banking activity decreased in Western Europe, but continued in the Byzantine Empire and the Islamic world. The Knights Templar, a Christian military order, established an early form of international banking, allowing pilgrims to deposit and withdraw funds across their network of commanderies. Fast forward to the rise of modern banking from 1400 CE to 1700 CE, the Medici family, an influential banking dynasty in Renaissance Italy, developed the double-entry bookkeeping system. This period saw the establishment of central banks such as the Bank of Amsterdam, which was the first bank to issue paper money, and became a model for other central banks established in Europe during the 18th and 19th centuries. The Industrial Revolution from 1700 CE to about 1900 CE brought about rapid economic growth and increased demand for banking services. Joint stock banks emerged, allowing people to pool resources and invest in new ventures. Central banks began to issue banknotes and manage the money supply. The 20th century saw the gold standard become the dominant global monetary system. Participating countries pegged their currencies to gold, facilitating international trade and investment. The gold standard provided stability but restricted countries' abilities to manage economic fluctuations, leading to its eventual collapse during the Great Depression. This led to the creation of regulatory bodies and insurance schemes to protect depositors. The latter half of the century saw the rise of multinational banks, the automation of banking services, and the development of credit cards and electronic payment systems. Finally, the advent of the Internet brought about the proliferation of online banking and digital currencies such as Bitcoin. The 2008 global financial crisis prompted renewed regulatory efforts aimed at bolstering financial stability and consumer protection. So, there you have it. A brief history of banking that has lasted through the ages, with all its ups and downs. Now that you have this context, let's discuss how banks worked in the past, especially during the era of the gold standard. The gold standard was a monetary system in which the value of a country's currency was directly linked to a fixed quantity of gold. It provided stability and facilitated international trade, but its inflexibility ultimately contributed to the severity of the Great Depression in the 1930s. Regardless, it's fascinating to see how banking has come a long way, from ancient Mesopotamia to the digital age. Thanks for watching.